All right, in a Squawk exclusive right now, we have activist hedge fund manager Bill Ackman this morning on his plan to save Fannie and Freddie. Bill is managing principal of Pershing Square Capital Management. Full disclosure, Bill is short the junior debt and the equity of Fannie Mae and Freddie Mac. He is not short the senior debt. Bill, welcome. Great to see you.
Thanks for having me.
All right, we've got Fannie and Freddie yesterday indicated to get back quite a bit of some of the losses from last week. As it turned out, they both closed lower yesterday in light of the plan that the government introduced. They're indicated lower today, slightly. Freddie will still be double its lows from last week. Sure. Fannie will still be 50% above its lows from last week when things seemed even more dire. But we did make the point that Freddie auction went well yesterday, and yet the stock still closed lower yesterday, still indicated lower today. Do you agree with this bailout plan that we've seen, or the steps being taken that Paulson put together? Will that be enough?
Sure. Actually, it's described as a bailout plan by the media, but it really isn't a bailout plan.
That's why I changed it to the steps taken.
What Paulson is doing is positioning himself to step in and save the day. Right? The authorization before was ability to buy $2.25 billion worth of debt securities, which is really irrelevant today in light of the size of these two entities. So what he's really doing is he's getting the tools for him to implement, if necessary, and I think it probably is necessary, the opportunity to save Fannie and Freddie. What we're trying to do is figure out a way to do it which minimizes the risk to the taxpayer, which I think is consistent with, if you looked at Secretary Paulson's statement, he said we want to do this in a way that minimizes risk to the taxpayer. And I think we have a solution.
We hear not enough capital, and then we hear again and again from Lockhart and other officials, plenty of capital, more than enough capital.
Right.
Is there more than enough capital?
No.
In a word, no? How can there be such differing interpretations?
I can make it very clear. The leverage of, I'll use Fannie Mae as an example throughout the program, but what I say applies actually even worse at Freddie. But Fannie is levered 138 to 1 in terms of their outstanding exposures, their outstanding liabilities. I actually got a little chart
maybe
here.
We can. I think that's the first one. Yeah, that you put together.
Exactly.
This one.
Yes, there's called 129 to 1 of total leverage versus common equity. If you look at it versus the preferred in common equity, it's really a 69 to 1 leveraged entity.
Is my telestrator on? I think I can see it right. Turn my telestrator on and it's right?
It's this bottom right box that gives you
the
leverage to equity. So you've got an institution. I mean, people complain about the leverage of Bear Stearns. They complain about the leverage of...
Which color box are we talking about?
The blue box here on the right. Take a look. This is kind of a summary of the leverage.
You can see 100 in total leverage versus common equity. You're talking about 129.
129 to 1 versus preferred in common. You see 69 to 1. And this institution is really a bond insurer. What does it do? It guarantees mortgages. It guarantees securitizations of mortgages, and then also it buys mortgages and it makes an arbitrage profit borrowing in the capital markets and owning mortgages. And the problem is that mortgages have declined in value, and there's very little cushion when you're levered 69 to 1.
Let's say Barron's is right, just for argument's sake, and that things get better from here. Are they capitalized enough at this point in time if things don't get worse?
Well, it doesn't. At this point in the market, it doesn't matter what OFEO says, the regulator. It doesn't matter what the rating agencies say about their capitalization. What matters is implicit guarantees don't work in a market that we're in now. What matters is capital. These institutions need to have a fortress balance sheet. Jamie Dimon talks about a fortress balance sheet. We need a Fannie and Freddie with a fortress balance sheet.
But I think Joe's question is more to what if home prices stabilize, foreclosures stabilize, delinquency stabilize? Can they survive if the housing market gets no worse than it is today?
In their current form, I don't believe so, no. And I don't think the housing market is going to stabilize where we are. So I think what you need is, in order to restore confidence to the financial system, you need the largest participants in the mortgage market to be extremely well capitalized, and they're far from extremely well capitalized. These institutions were set up in a different era, and they need to be able to withstand the perfect storm. It's now the perfect storm.
Bill, when did you start shorting the stock and start shorting the junior debt?
I woke up on Thursday morning with an idea. I've been trying to figure out how to save Fannie and Freddie. Why? Because of the long side of my portfolio, right? And because it's good for the country. And I came up with an idea, and the more I thought about it, the more logical I thought it was, and therefore I thought it would ultimately be implemented. And if my investors don't like me wasting time on things other than investment, so we had an opportunity, I think, to position ourselves for what we thought would happen in a restructuring of these companies.
And it's the age-old, whether you're talking your book when you come out because you've got the positions, or whether you got the idea first and put your money where your mouth is for what you think is going to happen. So we need to get that out in front that's what we're talking. Because your plan involves the common equity going to zero.
That's correct.
Extinguishing the common equity. That's not the first time we've talked about it, though. We talked about it a lot last week, and for a while, people actually said it might help Fannie and Freddie, and it might help preserve the institution itself, and it might help the housing market were that to happen. But here's part of your fix.
Can you walk us through,
walk us through what you plan.
the common, what happens?
Here's what happens. What happens is, what I think people don't realize is, today a private investor will not put money into Fannie or Freddie, in my view. The equity is too far out of the money. There's too much debt. And therefore, the government should not put equity in. If a private investor won't put equity in, the government should put equity in.
So you don't like that part of Paulson's plan?
Well, Paulson hasn't said what he's going to do. He's only sought authorization. Now, we have a way to take Paulson's plan, restructure the balance sheet so the government can, if necessary, make an investment that's a safe investment. So basically, we think what should happen is the common equity in front of the preferred equity should be extinguished. That's, investors made a bet, they received dividends, and so on and so forth over an extended period of time. They allowed the institution to become too levered. They chose these directors, or ultimately what happened.
How might a restructuring work? Common and preferred equity extinguished. You said that. Did you go on to the subordinated debt?
Let's talk about the subordinated debt. The subordinated debt holders received an excess yield. This is not the senior debt of Fannie Mae. There's a relatively small amount of it outstanding. There's about $11 billion of it outstanding. And we believe the subordinate debt holders should get warrants. So what we're doing is what I call it's almost like a prepackaged restructuring, but instead of a bankruptcy here, this is a conservatorship, which is actually a good thing because you can accomplish it more efficiently.
Right.
The next
Can we bring this up, or do we not have it?
Well, hopefully you'll have it.
Here it is. It's how might a restructuring work right there.
Okay, so what comes next? The next thing that happens is Fannie and Freddie actually have all of the capital they need. They've raised money in the debt and equity markets. The problem is that the balance between debt and equity, there's just too much debt and not enough equity. So what are we going to do? We're going to give the debt holders 90 cents on the dollar in new Fannie Mae unsecured debt. So instead of $750 billion worth of debt, there'll be $675 billion worth of debt.
Mm-hmm.
That raises, we're reducing debt by $75 billion, that raises equity by $75 billion. By eliminating subordinated debt of $11 billion, you're creating another $11 billion worth of equity. Mm-hmm. Now what happens to the 10 cents? You're giving people 90 cents. What's going to happen is the senior unsecured, the holders of the Fannie Mae debt that's all around the world, they're going to get ownership of the company. They're going to become the substantial, 99% of the equity is going to go to these holders. Then you say, well, what's going to happen to the money market funds that bought this paper? They're getting 90 cents as money good. What about the equity? Well, here's where the government steps in. The government agrees for the next 3 years to buy that equity at cost, so that those holders, the money market funds, the Bank of China, the sovereign institutions that bought this debt assuming an implicit government guarantee, they get their money back if they want. And now the government, the government effectively writes a 3-year put on the common.
Right, 3-year put on it, and then it benefit theoretically if it's a great business, as you point out. With given a strong balance sheet, it's a great business.
That's correct.
All right.
And the government, I think, ultimately will never write a check. Why? Because what will happen is this institution has significant earnings power. It's going to be able to write new guarantees at more favorable, more conservative terms.
People who got in are going to want to stay in other words.
I think that while some of the existing holders are going to sell, a money market mutual fund doesn't really want to own equity in Fannie Mae. I'm a buyer of Fannie Mae in the newly structured model. Now, what I would like you to do, if you would, if you can go to this...
You're a buyer of the common shares in the
Which
newly
one do
structured?
you want now? Because we didn't show the hypothetical. Yeah,
go take a look at hypothetical restructuring.
What it does, because senior debt goes down.
Okay.
It basically converts $75 billion in senior debt to $75 billion of new common.
Let me just walk you through this. If you go to the left side of the page, what you see is Fannie Mae today has $750 billion of senior debt outstanding.
Yes.
They have $11 billion of subdebt. They've got $21 billion of preferred and $24 billion of common. That's at book value.
Yeah, I know.
And that's book value.
About $9 billion.
Sure. Right? What we did here is we said March 31, and then we actually gave Fannie Mae the benefit of the equity they've raised since the end of the quarter. Okay, so they've got, call it $56 billion of old equity. We now take the senior debt, we reduce it to $675 billion, creating a $75 billion equity infusion. Now you have the new common of $75 billion, the old junior debt that's been converted into equity, and the old equity of $56 billion, and the new balance sheet now has $131 billion of equity. So it's a new infusion of $75 billion from the debt reduction on the senior debt, $11 billion on the sub-debt. Now, what does this do to those same ratios? If you guys can go to the next page, I think you'll see this. You now have what I call, we'll call it Jamie Dimon's fortress balance sheet.
Right.
Instead of 130 to 1.
You got 41.
It's 41, which is still a fair amount, but again, that's just to common equity. To total equity, it's 23.7 to 1. And in light of the earnings power of this entity, it's going to continue to build equity over time. So I think it could be actually quite a good investment. Once what we're doing here is we're resizing the balance sheet of Fannie Mae. We're changing the proportion of debt and equity. So it's a solvent institution. We don't need a rating agency.
We're going to take a break, Bill, and then we're going to talk about, we've got to point out, you would love, with your position, if the common gets extinguished, you go to zero. That's the most money you can make on your position, right? Sure. Plus with the junior debt. But then we also I want to talk Lehman and a private, whether that makes, I want to talk a lot of things.